I decided to leave JP Morgan because I don't know if you've ever seen the movie called The Big Short. So like that was literally my life. What was happening is once we on the banking side were no longer able to offload mortgages to include in investors, I saw that, the writing was on the wall and basically everyone's going to get fired. And that's exactly what happened. So now when I talk to people and I try to warn them, like right now, one thing that concerns me is this whole private credit thing, which is basically hedge funds giving out loans and stuff to other companies for buyouts or whatever.
What are people seeking now in the age of meme stocks and crypto? What is your audience asking you?
It's always the same thing. It's always whatever the shiniest stock is that they've received, some news flash on TV on, or their neighbor while they walk the dog home, hey, did you see that stock? It's always that.
But who are the sorts of, client profiles? Is it people who are suddenly getting older and whose wealth is starting to get to a meeting place where they want to make sure it's stable to a point?
It's very, very interesting because you have a generation there that still has all the wealth in the United States, right? And so there's that wealth transfer that's coming, but that generation has also in many ways never really had a problem financially. Go make a sandwich in the kitchen, come back and the markets are back at all-time highs. So it's just at some point when it's done, it's just really done. And I personally am unbelievably concerned for that, particularly for that cohort, the baby boomers. The younger generations, they don't know what they don't know. They don't even know that markets have cycles because there hasn't been one in 15 years. Conference you and I went to the year prior, I got back and I spoke to a very experienced friend of mine in the markets, and I told him, it's amazing. All these brochures in this exhibition hall, it went back exactly 15 years in terms of track record. And he said something that I thought was really, he's like, that's just long enough to erase memory.
Serge, welcome. It's a pleasure to have you on Advisor Ally. How are you doing?
Hey, Vineet. Thanks for having me on. It was nice meeting you a while back, and now here virtual.
I know, very different surroundings, but obviously we had a 15-minute conversation, which was extremely stimulating for me.
Likewise.
That has led to this today. Tell me, Serge, are you in Switzerland now or still in Florida?
Right now, I'm in Switzerland, but I'm going back to the US in just a few days, actually.
Okay. And so how do you split time between the two countries, and why is that the case?
Well, I've got my clients are in the US, but I've got some family in Switzerland as well. So I go back and forth, but I'm for the majority part in the US.
Got it. And based in Florida, right?
Yeah, we're based in Florida. The companies are.
And what I'd love to start with, Serge, is a little bit about your backstory, your journey, right? And you started as an analyst and in the markets with JP Morgan, and then to where you are today. But love to hear that in your words, how it's unfolded in the last 15 or 20 years.
Yeah, sure. Well, if you might recall or may not recall, we had something called the .com bubble back in the late 1990s. Basically, ended up sort of bursting in 2000 in the year 2000 in the spring, March, April period. And I had a couple of offers from investment banks in the fourth quarter of basically 1999. But then the investment banks, for the most part, froze what's called their analyst program, which is like when you go in as an analyst and you start going through the whole investment banking thing. And so they rescinded those offers, which was had never happened before. And so I ended up going and working for a company called Bloomberg, which ended up being a blessing to start off and doing some analyst work there. And then from there, as we kind of got through the .com bubble, at the back end of it, started then getting into investment banking programs from there. So that's kind of how that went. And then, and then I just did the classic sort of investment banking, footsteps. And that was at JP Morgan. And that was a very rewarding time because, one of the things that I wish more people got to see is how the inner workings of Wall Street and sort of in layman's terms, how the sausage is really made, because we live in this world where everyone's running around with a phone and an app, and they really think they know what they're doing, without sounding derogatory. Most people have no clue what they're doing in the markets. Zero. The only reason they're making money is because the U.S. markets have basically bubbled higher for 15 years with like no volatility for the most part. So I think if people understood how it's properly being done, they would be way more careful with their money because it can go away very quickly. Now, again, 15 years of a raging bull market, that's a lot of muscle memory, as you and I discussed in Florida together, right? And so that's what I'm very concerned about. But anyway, that's more sort of a side mark.
I know you're very passionate about this topic, and I will definitely get into it again. But you didn't quite close the chapter, the story there, right? So JP Morgan, and then what?
Yeah, sure. No, sorry. I'm sorry for jumping around. What ended up happening is I traded through part of the great financial crisis, which was basically 2000. It started in 2007, the cracks, and then 08, 09 were like the big problems. And then in 2008, it's now been a while, right? I decided to leave JP Morgan because I was really, I don't know if you've ever seen the movie called The Big Short. If you haven't, you should watch it. It's a really good movie.
Yeah, I loved it. Yeah.
Perfect. So like that was literally my life. I was more on the banking side, like the Deutsche Bank guy. Ryan Gosling, I think was the so that was more, but he was really just like that movie. It was, I could tell you stories like literally exactly that. Like it was very well depicted. But then what was happening is once we on the banking side were no longer able to offload mortgages to, us clued in investors, I saw that the writing was on the wall and basically everyone's going to get fired. And that's exactly what ended up happening. So I left before that happened, went to work for a family office in New York and we managed through that very well. And then along the way, at some point, I just continued to write my analysis publicly. And it just turned into essentially a newsletter business and analysis business, basically. And we added on an investment advisory business. And so it just kind of snowballed from there. And here we are.
Very interesting. And I think, the more I talk to advisors and people like yourself, everyone has a very interesting story that ultimately leads you to this profession. And your story is interesting. I actually got into banking and started my career during the financial crisis.
Wow.
And you've obviously seen that and the .com boom. Did that change your view of the world? Obviously, from a career standpoint, you made some moves.
Oh, there's no doubt. There's no doubt. And this is proven, right? I mean, there's papers written about this, right? So depending on where you start in your career, whatever that initial sort of 5 to 10 year period was, or even maybe less, is going to be ultimately if you're going to be permanently bullish or permanently bearish. I will say there are exceptions. I'm actually about to go have lunch with one of my very close friends, and him and I literally started together like step by step. But he's a permanent bull. But it's because he's turned into, there's a lot of groupthink on Wall Street, and he works on a bit of a different side of the business where there's a lot of groupthink. And so, if they're all bullish, because they have to be, it's always like, yeah, at the end of the day, yes, there's a different view that you get depending on what you experienced early on in the career. But at the end of the day, you have to make money for the firm, right? And so if that pressure is large enough to overcome your initial bias that you had, then that can switch. But I see that it's more rare, and so now when I talk to people and I try to warn them, like right now, one thing that concerns me is this whole private credit thing, which is basically hedge funds giving out loans and stuff to other companies for buyouts or whatever. That to me is very concerning. But again, I have to be honest with myself and say, why is that concerning? Well, because it very much sounds like what we have in the great financial crisis, not so much that it's the same. It is different. So anyway, but to answer your question, yes, these things leave a mark.
No, and I think that's where your experience and work kind of brings value, right? The folks who decide to work with you as investor clients. So point very, very well taken. But tell us a little bit about Blue Marlin. I know you run it with a partner.
Yeah, what happens is, I've always done sort of advisory, if you will, in different capacities, whether it was on the investment banking side or then looking over portfolios or managing or advising on them. And so when we started the newsletter business, which is, newsletter is a sort of a broad term. It's, what we do at the studytrader.com is we essentially send out trade ideas. It's none of it, they're not recommendations, right? It's just publishing. It's like a newspaper, if you will. We have indicators for people and we just educate them basically. It's really the terminology on markets. So it's not recommendations. But what we noticed is that there are people who at some point realize how much it would take for them to really learn enough about all of that to actually manage all of their money, which is that's their goal. But almost no one achieves that, because it's one thing having a little trading account and maybe having your Robinhood app, or in your neck of the woods, I know there's a lot of apps like that as well, right? It's one thing doing that for fun, or, I mean, they're serious about it, right? But it's a very different thing than managing your whole portfolio. And so we noticed over time that will be a need. As we're recording here, you and I will tell you that a lot of people, it's actually gotten worse. More people now believe that they can manage all their money because what we said before, 15 years of raging bull markets with no volatility. So Blue Marlin is there to ultimately help people actually manage their net worth and not just their trading account, which we want people to do, right? Because that's what they want to do. I just think a lot of people will realize in the coming years that there's a huge difference between that. But again, you need the market to do some work for us on that, for people to kind of realize that. You get it a little bit when there's a bit of volatility spikes, but the volatility spikes are so quick, and before you know it, you're back to all-time highs.
Yeah, you're right. And I mean, we saw a little bit of that earlier this year, but it was short-lived. And obviously, there's a little bit of panic back then, but people seem to have forgotten it already. That's another thing these days. I think public memory is very short.
Well, but that's the problem, right? I went to the conference you and I went to the year prior. I got back and I spoke to a very experienced friend of mine in the markets, and I told him, it's amazing. All these brochures in this exhibition hall, it went back exactly 15 years in terms of track record. And he said something that I thought was he's like, that's just long enough to erase memory. And and sadly, a lot of people that are busy in the markets right now have only been around, forget 15 years, 5 or 10 years. But they talk like they've been around for 50 years, but they haven't. They've not seen a cycle. And it's one thing reading about it in a history book and saying, I can, or backtesting some sort of model. It's very different when it hits. And that's my concern. And that's why we started Blue Marlin, to ultimately help people actually with that, because there will be a point that it's probably not too far away when people realize that, my Robinhood trading account, or again, whatever other account or apps like that in the world, is not going to save me from that, from my net worth.
Right. And at Blue Marlin, right? I mean, I think this is very interesting, and you're absolutely right. I think S&P has on an average grown over 10-15% the last 25, 50 years. Like you said, the last few years, everything seems to be just going up, no matter where you put your money. And obviously, there is very much a need for an advisor beyond just that. But who are the sorts of client profiles who are identifying that need and coming to yourself and people like yourself? Is it people who are suddenly getting older and whose wealth is starting to get to a meaningful place where they want to make sure it's stable to a point? I mean, are there any kind of...
It's very interesting. So we have a lot of baby boomers, which is basically the generation. I think the oldest ones are now probably late 70s, early 80s, and the youngest ones are probably still in their 60s. Or something like that. And again, everyone can sort of chat GPTs to get a better definition, but that's roughly where you're at. So the average is about 72. It's very, very interesting because you have a generation there that still has all the wealth in the United States, right? And so there's that wealth transfer that's coming, but that generation has also in many ways never really had a problem financially. And I'm blanketing this here by, obviously people have hardship and so forth, but a large part of those people had corporate jobs, or basically coming out of World War II in the West, were lucky to start a company, and lucky in a sense that they had that tailwind. Obviously still required a lot of work. And so they never had that financial insecurity problem. That cohort of the baby boomers, not the entire generation, but it's a lot of them. And so when they started looking at their money for the first time, when they started retiring, which was about 15 years ago, the average, right? Which is when the bull market started. Before then, they just had their IRAs and 401ks, which in the US is the retirement tax thing accounts. They started, taking a more vested interest in their own money and thinking about doing it themselves. And also because a lot of the financial advice that they had before basically blew up their money twice, right? Once during the dot-com bubble, and then once, the GFC. And so I understand that part. The problem is that they never really cared enough to do a change because they were still working that income. Then they retire, and then the market just rips higher at 15% a clip a year with no volatility based on 7 stocks, right? And so you have, it is, I think, as I explained to you, it's very difficult to reason with someone like that. In fact, I actually think it's impossible because 15 years is a very long time. And, you go back to your point earlier this year, we had a 15, 20% drawdown. You go make a sandwich in the kitchen, come back, and the markets are back at all-time highs. And all that does is it further builds the biceps, the muscle memory. So it's just at some point when it's done, it's just really done. And I personally am unbelievably concerned for that, particularly for that cohort, the baby boomers. The younger generations, they don't know what they don't know. They don't even know that markets have cycles because there hasn't been one in 15 years, And so I'm very, very concerned. And I think everyone now says AI and all this stuff. Look, you at the end of the day, an investment advisor is a relationship you have with someone. And that person knows you. That person should know your family to some extent. It's not about managing the money all the time. I mean, that is the core thing. And I know some people do financial planning and stuff, but managing someone's money should also, to a large extent, take into account what's happening in your life. If your daughter's getting married, and I know you guys have big weddings in your neck of the woods, right? That's can be, let's say, an expense that may have to do something to do with the portfolio and whatever. I mean, you can go on and on and on. Or house renovations, you get hit by a tornado. Those are important facts to take into account.
And Sergio, actually, that's actually totally aligns with another conversation I had where an advisor who's been doing this for, I think, 25 years or so, 30 years almost, maybe. And he said, at the end, a client doesn't thank me when he's 70 to say, you helped me get me to a net worth of, 3.4 or 3.5 million. But you've helped me in those pivotal points in my life where I needed something or I needed good advice. And that's what I'm thankful for.
That's right.
Obviously, it's nice to be where I am right now. So I think what you just said there made total sense.
But that, Vineet, is the problem we have right now. People don't know that moment will come. And they just can't fathom that an advisor will be helpful at some point because they don't see that event ever coming. Even if it's in their roadmap of it possibly happening, because it hasn't happened in so long. And again, they keep being proven right that it hasn't happened.
Yep.
It's the money talks, right? So it's just the fact that their money hasn't gone down in any meaningful fashion. That the best way I can explain it, and I will say this is not meant to be calling these people, alcoholics, but it's like talking to someone that's drunk. And you try to reason with that person. You tell them, hey, here's this, and this, let's do this. And they will nod. But literally, like 1 second later, they will do the exact opposite of what you just said, right?
Yeah.
It's exactly like that. And it's not because they're dumb or anything or any influence. It's just because money just speaks louder. And that's a problem.
And to your point, there's a lack of evidence as well, right? I mean, recent history, obviously a couple of months back, the markets bounced back up. Even COVID, it dropped significantly, but a month or two later, or maybe a few months later, it went back up. So, why would someone disbelieve that?
That's the problem. It's factual, right? And then there's the other thing, and what this brings about. So let's take just April this year, right? We had the tariff thing.
Yeah.
Right. And as a risk manager, as a portfolio manager, you better do something when that happens, right? Because you don't know, maybe this persists. The retail community, not only did they do nothing, because their expectation was V-shaped, which was proven right once again, they actually bought more, right? The professional community, particularly the hedge funds, but also I would say investment advisors worth their salt, we're busy doing something, taking that gross exposure, and then end up looking like idiots in the end for having actually risk managed the portfolio, right? So I was trying to explain this to a prospective client the other day. It's like, listen, the worst drawdown that our portfolios had was 5% in April. The S&P was down 10. Most NASDAQ heavy stocks portfolios, which was what most people have in the US, were down 20%. So we had a very little drawdown. So our clients slept really well. But now our portfolios were up, right? But we're not up 20%. Some portfolios are up, 4, 5, maybe 10%. Some might be flat, right? But at the end of the day, all they care about is the bottom line. They don't care about the risk managing. And that's, again, it's another derivative of unfortunately, what I think is it's really not going to end well. I mean, there's no doubt about it.
Right. And actually, I think I was just thinking in my head that this 5-6 year, what we could call an anomaly of the markets is never going to be good in the future when someone comes out with a portfolio strategy and tries to backtest it using the data of the last 5 years. It's not going to help.
Well, that's the thing, right? So just going back to my point before from that conference you and I met 1 year prior, even just when we were at that conference, the same thing. You look at the brochures. I went around there, and I have them over here somewhere, all my stack of brochures.
Right.
And in fact, I'm not going to show them on the camera because I don't want to expose anyone, but let's just see. Let's just peruse. There you go. So we've got this one goes back to 2021, 2022. Okay, that's pathetic. 2020. We've got some other ones going back to 2018, 2015. Well, there's one back 2011. Okay, that's as far as they go back, and that's in one market, you know. But again, it's just this. The crazy thing is you can't explain that to people because they just haven't experienced anything different in 15 years. Right?
Yep. But shifting gears a little bit, actually moving to a steady trader, and obviously you've been sharing knowledge, if that is the right word, to investors around strategies and angles that they could look at. What are people seeking now in the age of meme stocks and crypto? What is your audience asking you?
Well, it's always it's always the same thing. It's always whatever the shiniest stock is that they've received some news flash on TV on, or their neighbor while they walk off told them, hey, did you see that stock? It's always that. So right now, it's a lot of nuclear stuff, nuclear energy stocks, or fusion, or local nuclear reactors. There's always an AI angle, of course, right? But those are all narratives. And some of these are great companies, right? It's just we don't really know. At some point there will be a hiccup moment. And we saw, they happen all the time. Last year, a lot of those stocks halved, and then everyone forgot about it. But that's kind of where, but this is the other thing about this. So that's kind of where they're focusing on. The problem with them focusing on those stocks is they are, on my guess, I don't know this factually. I mean, we can check broker statements by brokers, not like individual people's statements, but like just getting statistics. Self-directed traders who lose money. There's no doubt about it. Over the course of time, right? Again, we've had an extraordinary 15-year period where probably more people than usually have made money, but just because the market's gone up. When it comes to the trading side on the steady trader, I really try to focus on repetition and education. Try to give people more than just, hey, here's an indicator, green light, red light. That's part of it, but you have to be able to contextualize it. The real issue I'm having is that people see no reason to learn beyond, again, green arrow, red arrow, because, again, the market's just gone up. So they see a green arrow and they see no reason to learn one. They say to themselves, and honestly, it's not even that irrational. They say to themselves, why do all this other analysis and look at the yield curve and this and that when all I have to do is green arrow up and momentum algos come in and push the stock higher? The problem isn't now. The problem is when that stops working and they can, and then the other thing is, even the people that lose money, and that's a lot of them lose money, they don't really care because most of them have portfolios on the side, like which is the majority of their money, that just keep bubbling higher. So if their trading account loses money, they don't really care that much, So that cohort, there's other cohorts too.
Cool. I know you made a brief reference to tech stocks earlier and AI as well, and that's a topic obviously close to my heart, and love to kind of understand, since you've established Blue Marlin, what has been your view on leveraging technology and where do you find most use for it?
Yeah, I think two things. I mean, what you and I talked about is essentially operational efficiency, right? I mean, that's, our Blue Marlin, our investment advisory business is very much based on scalability, meaning that's the goal, right? Because we have a large amount of clients that follow us on the subscription side, and those are completely legally separate companies, and so there's a big compliance thing. So I want to get into legal and compliance problems here. We have to check all this and do it properly. People naturally get interested in Blue Marlin just because they find out that we also have that. So it's more that than us going out there and pounding them with it, because that would not be compliant. However, so because of that, we really want to leverage technology, right? So we leverage technology, but in AI specifically, in two ways. Number one is the and this is not number one in terms of sequence of importance, but just the first thing is for the content itself, right? So the research basically. So we'll use large language models and all that, obviously, to help us in the research aspect, maybe helping explain to people something about their portfolio. It's a quick query on one of the, LLMs, and that really speeds up time. There's no doubt about it, right? So any kind of research related. But quite frankly, where I find right now, so that's been happening for a while. That's nothing new. That's been going on for a good 12, 18, probably 12 plus months. Where I think there's a lot of help still needed, and I know this fits into your thing, is really on the operational side. And I saw some of you guys' emails that come out, which is really speaks to the pain point. And it doesn't matter if you run a family office and you're going after, 5 billion a year clients, you don't need that. But if you have a lot of clients, and our goal is thousands of clients, because it's more of a leverage thing, you need ways to be able to be operationally efficient beyond our even current wildest imagination. So taking, client notes that we had on a meeting, automatically dumping that into a CRM, summarizing it, next step. The more automation, the more I can scale this. Because if you think about it, Vineet, we have we have two investor classes trading, really traders right now. The baby boomers that we said, right? And at some point they will be done trading. Number one, due to age, and number one, due to the thing we said before, or they will trade less, right? Or more focused, and so with less wild. And then you have the younger generations. I'm going to say 35, 40 and up. All those people at some point will realize, in my view, that they shouldn't be doing this alone, right? Robo advisors and all that kind of stuff. It's nice. We're still human beings, right? And I realize there's a bit of a cultural thing and a generational thing. I see it with, our children. One of them is now turned a teenager, and it's just a different way of dealing with technology, right? I mean, I know it sounds like you have children, so it's a very different way of dealing. But I do still think as human beings, we ultimately, it helps able to talk to someone. And so the more, so that's the intersection of, getting people educated on the trading side, and how do we get them to understand that that's nice, but they need an investment advisor to actually talk to, because we cannot give advice on the steady trader side, right? It's purely educational. It's signals, ideas, education. So, but only on the Blue Marlin side, you say, hey, listen, Frank, I know your entire portfolio. I know everything about you financially and personally. I think this is a good idea. Maybe for the portfolio, for the long-term stuff, but maybe for a trading account, right? And that's not any app. Nothing will be able to do that for you. Number one, legally, that can't happen in the classroom, because you have to be an advisor, and 99% of the educators out there are not going to be advisors. So technology is a huge, huge, huge part. And, as you and I discussed, I'm really just beginning to really go on that journey on the operational side.
Yeah, and as are many. And to be fair, I think the last 12 months has opened a lot of eyes beyond the early adopters. And to your point, I think operational areas, if that can be optimized for you, then you can focus on just advisory and engagement. And in fact, a point that stayed with me is AI makes advisory more human, actually, because you don't have to waste time on the stuff that you don't want to waste time on.
For sure. But I think one thing, Vineet, that's to me, that's one of my main challenges, is just getting people to understand that they need a human to talk to, right? Just to bounce ideas off of. Like going into a chat room, yes, that's nice, but that is not personal. Like at the end of the day, even if you get a trade idea, let's say on the very superficial level, like forget an investment idea, there's no talk about sizing. No one can tell you how to size that position. And that, quite frankly, is probably 80% of the conversation. But people don't understand that, again, because of the bubble, the gambling bubble we're in. They don't think sizing matters. They just want the idea. And then they usually either way oversize it, or they make it so small that they forget they even have it in at some point in 20 years. Or they usually do options nowadays, in which case it expires in 2 weeks, in which case they blew up all their money.
All right. No, fascinating conversation, Serge. I think let's see what the markets do in the next few years. I'm sure you and I will catch up a lot more often, so we'll track it together.
Yeah.
But, would like to close this conversation with something maybe slightly outside shop talk. What keeps you happy outside of the markets and advisory? What's your kind of
Well, I think,
poison?
family obviously is important with my wife and our children. I think, spending time there. I like to, admittedly, I work a lot. So it sadly feeds into the weekends too. But I've over time learned to delegate, and obviously as the companies grow, you hire more people. But I do a lot of sports, so I go to the gym every day, and on the weekends, I play a lot of golf in Florida. I do a lot of snowboarding in the winter
Okay.
in Switzerland. And, how about yourself?
Yeah, no, obviously I've got two young kids, so they're a handful outside of work. But like you, I think sports, we used to play a lot of cricket, with football or soccer.
Yeah.
For the US audience, more recently a game called paddle. I don't know if you've picked that up. It's
Was it? Is that like? Is it like?
Squash and tennis. So it's a bit easier on your body, I would say.
Right. But is it some racquetball like that kind of thing? What is it
It's
called?
a bit similar. I think you're talking about pickleball.
Pickleball. Yeah.
Yeah. So it's similar, just that the rules and the gameplay is a bit different. Yeah. But again, like pickleball, it's something that's really kind of caught on in the last couple of years.
Yeah, it has.
So that's something that I try and do as well. But listen, I know taken a lot of your time already, but it's been a fascinating conversation and as stimulating or even more than last time. So I appreciate and you're very candid, which is great. So thank you for your time again, Serge. And
yeah, I appreciate it, man. It was good talking to you. We'll keep the conversation going.
Perfect. Sounds good.